All right, so I am going to review with you what we did from Learning Objective 1 to help you understand what we're doing today. Okay. So first of all, can everyone see the transactions that we went over on Monday? Yeah. Okay. I want you to notice that each of these are individual accounts. Cash is an individual account, all by itself. As you see, only two things can happen in the cash account. We either have more cash or we have less cash. Nothing else happens in an account other than we have more of it or less of it. Okay. Supplies is its own separate account. And again, only two things can happen in the supplies account. We either have more supplies or we have less supplies. Prepaid insurance is its own account. Only two things can happen in this account. Either we have more prepaid insurance or we have less of it. Same thing with the equipment account. We either have more or less. Each of these are separate accounts with its own separate record in accounting. On the liability side, you saw this. We have notes payable. Notes payable is an account, a separate account. It happens to be a liability account, but it's a separate account. Only two things can happen in this account. We either have more notes payable or less notes payable. Same thing with accounts payable. It's a liability account. And in this account, only two things can happen. We either have more accounts payable or we have less accounts payable. Unearned service revenue is a liability account. But again, when you look at the account, only two things can happen in the account. We either have more unearned revenue or less of it. Common stock is its own account. And again, only two things can happen in the common stock account. We either have more shareholders or less shareholders. Okay. We have specific revenue accounts that you learned about. Well, in this case, for Sierra Corporation, there's only one, service revenue, because all they do is give tours. Service revenue is an account, and only two things can happen in the service revenue account. We either have more service revenue, or we don't have any at all, or we lose it. All you need to worry about is, in many cases, in this case, whenever we earn money, we're going to have more revenue. There are individual expense accounts. Each will be listed separately on the books of a company. So a company will have those expense accounts kept separately for the record. There'll be a salaries and wages expense. There will be a rent expense. There will be a supplies expense, etc. All of those accounts will exist in a company record. And only two things can happen, okay? We either have more of that expense or we have less of that expense. In our case, because we're at the beginning of accounting, we're just going to see more expenses, okay? And there's a dividends account. Again, a dividends account exists on the books of corporations. And again, for the sake of argument, we're only going to be looking at this account in two ways. We have either more dividends that have been paid or we have less. But in our case, the book limits it to just simply having more dividends being paid. Okay. More dividends means less retained earnings. More expenses means less retained earnings. But more revenue, which is the source of the profit. Remember, the revenue pays for all those expenses. It also gets shared as a dividend, right? And the rest of it is retained. So revenue, in essence, increases retained earnings. Right? That was really important to get from last class, okay? As you see, we have, in the very, very first transaction, we know that the companies, the investors put in $10,000 of cash for $10,000 of common stock. And so you see in our analysis, right, we could think and say, okay, we have more cash because the company just received $10,000 cash, but the company now has $10,000 more of common stockholders, right? That's the shares of stock that are represented for that investment, 10,000. But again, this is not accounting. This is simply analysis. What you're going to be learning today is actually how do we do this accounting? How do we say we have more cash in the cash account? How do we say we have more common stock in the common stock account? That's what we're going to be learning today. Okay? So I'm going to go ahead and flip here. Stop the share for a moment. Bring us back to this. I'm going to bring you to Wiley Plus, just to explain that again. All right, so your Wiley Plus book, and if those of you that actually have your book open, if you can turn to page 100, you'll see this illustration, okay? And all this illustration tells you about is what an account looks like, okay, for accounting. This is a very simple way of looking at an account. But the title of the account is simply the name of the account that we just looked at. So we saw cash. Cash is the title of an account. We saw accounts receivable. That's a title of an account. We saw supplies. That's a title of an account. We saw accounts payable. That's a title of an account. We saw common stock. That's a title of an account. So all the accounts the titles will be on the top here when you see this picture of what an account is. And as I told you, like a coin has two sides, an account also has two sides. The left side of an account is called the debit side. That's all it means, is the left side of an account. So in accounting, we call the left side of an account the debit side. The right side of an account is called the credit side. So again, all accounts have two sides, right? A left side, that's called the debit side. The right side is called the credit side. What you need to do here is forget about everything you know about the words debit and credit from the banks that you've been dealing with in your life thus far. It's not the same as a debit card. Put that out of your mind. This is not banking. We're doing accounting here. This is not the same as a credit card. Put those words aside. Okay, those are financial terms. We're learning about how to do bookkeeping and accounting here. Okay, so all you really need to know is when you hear the word debit side, it's simply the left side of the account. When you hear the word credit side, it's simply the right side of an account. It's the same as, like I told you, when you have a coin, right? Whether it's a penny or a nickel, it's going to have two sides. It'll have the heads side and the tails side. That's how you need to look at this account, just like you would look at a coin. A coin, regardless of what the value of the coin is, doesn't matter. It has a head side and a tail side. Just in accounting, we have specific names for the left and right side of an account. And again, like I was telling you earlier, the good news is only two things can happen in an account. You can either have more of it or less of it. So cash is the busiest account, and you all have savings accounts and checking accounts, and you know only two things can happen in those accounts at your own bank. You either put more money in it, so you have more in the account, or you start writing checks or doing withdrawals, and you have less money. That's the only two things that can happen in your savings account or your checking account. More of it or less of it, that's it. Same thing in accounting. In every single account, whether it's cash or supplies or accounts payable or common stock or retained earnings, you're either going to have more or less of it after a transaction is done. Okay. So this is very important to understand, that all the account names are the titles, and that every single account has a left and a right side. The interesting thing to know is that one of these sides increases the account and the other side decreases an account. And this is where it gets tricky in accounting, because assets, for example, asset accounts like cash and supplies and equipment show more of it on the left side, show less of it on the right side. But it's just the opposite on the other side of the balance sheet. On the liability side and on the equity side, the right side or the credit side shows more of it. And when there's less of it, it goes on the other side, which is the debit side. So this is going to be the trick for this chapter, is to sort of understand if it's an asset account, asset accounts increase on the left side of an account, which is the debit side. And if you say you have less of an asset, like less cash, you show that on the right side of that account. The opposite is true on the liability and equity side. Okay. And again, there are wonderful illustrations in your book that I would recommend that you look at, so you can make note of that and keep that handy as you're doing your work. Okay. So here is what we looked at this is what happened to the cash account during our long history of events for Sierra Corporation from last objective, right? Sierra Corporation had lots of activity in their cash account. So here shows that they had more cash come in, because the very, very first transaction, as you remember, was the stockholders, the investors, put in $10,000 of cash for $10,000 of common stock. You and I analyze that as more cash. How accountants and bookkeepers say we have more cash is to say that we debit cash for $10,000. That $10,000 increase simply shows up on the left side of the cash account. The left side of the cash account is called the debit side. And so how bookkeepers and accountants talk about this is, oh, we're going to debit cash for $10,000. That's just their way of talking and saying we have more cash, $10,000 more in cash. Notice when we really needed cash, in this case, we used this cash to buy equipment, which means that we used the cash. We had less cash. Well, to show we have less cash, we have to put those numbers on the right side of the cash account. And so that means that every time we credit cash, we have less of it. Again, you need to think of it as only two things can happen in a cash account, in any account. You either have more of it or you have less of it after an event and a transaction occurs. All of the numbers here that you see are reflected in all the events from Sierra Corporation in Objective 1 that we went over last class. This is actually how it looks in the account form. Okay, so every time more cash, we analyzed that the company got more cash, we would show those on the debit side of the cash account. The debit side of a cash account indicates more cash or increases in cash. Every time we used cash to, in this case, buy equipment, to pay bills, our expenses, every time we used cash, we show we had less cash on the credit side. It simply shows a use of cash. But this is how accountants and bookkeepers talk. They use the term debit to indicate the left side of an account, credit to indicate the right side of an account. Okay? That's going to be important going forward. I'm going to stop my share, bring us back to the main screen, and ask if there's any questions on that so far? How did that, do you sort of understand in essence that each account has two sides? The left side has a name called the debit side. The right side has a name called the credit side. You have to forget about all the stuff that banking has taught you. We're not doing banking. This is not a banking class. This is accounting. Okay? So jettison from your head the fact that you might have a debit card or a credit card. Who cares? Right? In accounting, debit simply means the left side of an account. Every single account has a left side. So every single account has a debit side. Every single account has a right side. So every single account has a credit side. It doesn't matter what the name of the account is, there's always two sides to the account. Just like it doesn't matter what coin you flip, penny, dime, quarter, it has two sides, the heads and the tails. Same thing in accounting. Every account has two sides. Just rename those sides. Okay, left side is the debit side. Right side is the credit side. That's one of the tricks you're going to learn here. Okay. So let's go back to, I want to try something with you. Let's go back to slideshow first, and then we'll go ahead and do a little exercise to see if any of this stuff is registering right away. Hopefully it will. All right, so where is my PowerPoint? Here we go. Okay, so we're going to come back to this screen a little bit later on, but first, let's go ahead and look at some information from Learning Objective 2, which basically started off by understanding the account, right? Every account will have two sides. The left side of an account is called the debit side. The right side is called the credit side. And this is important because for every single transaction, I told you at least two sides, two accounts are going to be affected. Well, guess what? Two sides are going to be affected, okay? For every time you are going to debit an account, you will also need to credit another account to balance it, okay? And this is going to be a good part of our lesson today, is to work on this. Okay, it'll get easier by the time we're done. Okay, as we saw here, and this is just from the PowerPoint, this is actually not directly related to, I think, any illustration in your book, but I'll get to that. Accounts have two sides. I need you to understand that what you'll see in the homework oftentimes, and even on accounting papers, like the journal, they abbreviate debit with DR, and they abbreviate credit with CR. But as you notice, it's still, the debit is the left side of an account, the credit is the right side of the account. They just use DR and CR instead of writing out the terms debit and credit. I think it comes from the, might be coming from the original Italian or Latin version of the word. Okay. So in this particular account, we see that there were 3 transactions in the account. 2 of those transactions affected the debit side or the left side of the account. One of these transactions affected the right side or the credit side. Okay. What we know is if we just actually let's label this account cash, just so we can get an idea of how we would look at this. In this case, cash as an asset account, we show that that when we have more cash or any increases in cash happen on the debit side. That's just the type of an account cash is. It increases on the debit side. So every time we have more of it, we put it on the debit side. Every time we have less cash, we put it on the credit side. Cash being an asset account will have a lot more increases to it than decreases to it. We're always going to need cash. And so we're going to need to assume in this case that we're always going to have more cash in the account than we're going to use. So the debit side balance is higher than the credit side balance by $15,000 because you have $18,000 of debits, $3,000 of credits. The debit side is larger than the credit side by $15,000. So again, the balance in this particular account, we say is a $15,000 debit balance, which for a cash account makes perfect sense. It simply means we have $15,000 of cash remaining. We had two increases in cash for $18,000, but we used $3,000 that had to be removed, less cash. So what's remaining is $15,000. That's basically a balance in an account, okay? And you'll see this over and over again, and you will get used to it, guaranteed. All right, I'm gonna go to a couple of figures in your book. Here's one of them, for example, that shows that every single asset account, and there's a lot of asset accounts, as you know, from that classified balance sheet you did, asset accounts all work the same way. They increase on the debit side. So every time we have more supplies, we put that on the debit side. Every time we have more prepaid insurance, we put that on the debit side. More equipment goes on the debit side. So that means we say its normal balance is a debit balance because the way an account increases, that should be the bigger side. And so that's going to be the balance in the account. All right. Notice that anytime we use cash, every time we use up supplies or use up our prepaid insurance, that we have to show on the right side, or the debit or the credit side. And so basically credits are should be smaller than the debit side, but credits show we have less of an asset. As I told you, liabilities and equity work the opposite. They increase on the opposite side, which is the credit side of the account. So having more accounts payable shows up on the credit side. Having more notes payable shows up on the credit side. This is how we say we have more liabilities. But then again, we often pay those bills. We pay our, we pay down our bills every month. So every time we actually pay our bill, we show less of that liability. Because again, only two things can happen in an account. You have more of it or less of it. When you pay a bill, you have less bills, right? You pay that electric bill, you have one less bill to pay. So we have to adjust the account accordingly, and we show we have less accounts payable, for example, on the debit side. So when that bill came in, we had more liabilities, more accounts payable. But when we paid that bill, we had less accounts payable. Right. The credit side and the liabilities will always be larger than the debit side. And so we say the balance, a normal balance in a liability account will show on the credit side. Okay. Again, the helpful hint here, a normal balance is basically where the increases are recorded, because that's always going to be the bigger side in an account. So we say that's the balance in the account normally. Okay. So that's the normal balance. Like I said, when we get to stockholders' equity, common stock is not a complex account. Common stock is not a complex account at all. Whenever we get, what's mostly going to happen here is we're going to have more shares of ownership that have been sold to investors. And so all you're going to see in this book are increases in common stock every time the company sells shares of ownership for cash. You're going to have more cash and more common stock. So you will often see just the credit side of common stock be affected. You will not see a debit to credit to common stock in this particular class. Okay. Retained earnings, again, you have to look at retained earnings in a broad way. Retained earnings includes revenues minus expenses. That's your net income. Right. And then we take away the dividends. So retained earnings is a stockholder's equity account, which is on the right side of the balance sheet. And the right side, or the credit side of the account, is the credit side. That's how we show more retained earnings. More retained earnings will show on the credit side. Less retained earnings will be on the opposite side of the account. Remember, every account has two sides. We're simply looking at one account at a time. And if it increases, it goes on one side. If it decreases, it goes on the other side, depending on the type of an account it is, right? You saw assets increase on the left side. Here, retained earnings, stockholders' equity account, they increase on the right side, which is the credit side. Dividends takes away from retained earnings. So every time there's a dividend, we have less retained earnings. Less retained earnings happens on the debit side. So dividends are going to show up on the debit side. You'll see the same thing for expenses. Expenses take away from the profit of the company. So expenses are often expressed on the debit side to show that more expenses means less less retained earnings, less net income. The opposite is true for revenue. Revenue is where the profit is. Revenue is where the net income is. Revenue is where the retained earnings are. So revenue, all revenues increase on the right side of an account, the credit side, just like retained earnings increases on the right side. Okay. Revenue is where the profit is for the company. Expenses and dividends take away. You take away. Okay, we're not doing that. All right, so I want you, this is a very good summary. I think there's actually a better illustration than this, but this is a pretty good summary. Let's see if the next slide has that illustration. Thank God it does. Okay, so this basically is on page 105. So if you have your book and you turn to page 105 and you look toward the bottom of that page, you will see this illustration, 3-16. And it basically is a great little thing to have with you when you're looking at the account. So if the account that's affected is an asset account, you'll see that the asset accounts increase on the left side, which is the debit side. But if we have less of that asset, it's going to go on the credit side. It's just the opposite on the liability and equity side. The liability side, if we have more liabilities, that's going to show up on the credit side. Okay. Less liabilities, whenever we pay down debt, we'll have to debit that account to show we have less debt in that account. The real thing here is stockholders' equity is a little bit tricky because it includes expenses and dividends. Stockholders' equity accounts increase on the credit side. They increase on the credit side. However, expenses take away from equity. They take away from the profit. So they are going to increase. More expenses show up as on the debit side because debits decrease retained earnings, and that's exactly what expenses do. They take away from the retained earnings. They take away from the profit of the company. Okay. Same story with dividends. Every time we pay a dividend, we have less retained earnings. So dividends end up on the debit side of an account because that's where we show less retained earnings. More dividends mean less retained earnings. Okay. All right, let me stop right there. I'm going to go back to our screen. I'm going to be asking you some questions. I'm going to be asking you to talk like an accountant, if that's okay. Let's go back to our, well, actually, I'm going to go back to the PowerPoint screen. Oh, actually, maybe I can actually do Wiley here. Okay. So I'm going to go back to our, this is a summary of everything that happened to Sierra Corporation from our discussion last class for Learning Objective 1. We went through a whole bunch of transactions. And what I want you to do is I'm going to ask you if you could talk to me like an accountant. Okay. Talk to me like an accountant would. So look at the very, very first transaction that you might remember from last class. We had more cash, $10,000 more cash, and we had $10,000 more in common stock. So how would a bookkeeper or an accountant talk about that transaction? Well, they're going to look at the account and see what side is affected. So they're going to say debit one account by this much, credit another account by this much. Okay. So who's brave enough to kind of go first? I know that's kind of the toughest thing, is to sort of go first, but I need you to talk to me like an accountant just for what happened in transaction number 1. Any takers? Otherwise I start calling people. I mean, I want everyone to have a shot at this, because through practice is how this is going to sink in.
I try.
Okay.
It's debit $10,000 in cash.
Yes.
And it is credit $10,000 in common stock.
Excellent. Nice job. That wasn't so bad.
It was.
It wasn't so bad, actually. It's going to get easier. It's like riding a bike. First time you get on a bike, you're probably going to fall off. No problem. Just get back up, right? Of course, there's no protective gear in accounting to do this stuff, like you could when you get on a bike. And maybe they'll do that someday. Maybe we can all wear helmets and masks while we're doing debits and credits. Maybe someday that might be the way it is going to be. But right now, you don't need that. You're doing good. All right. Look what happened in the second transaction. Remember, they borrowed money from a bank. So when we looked at the second transaction, whenever you get a loan, you get the cash. So we saw we had more cash in the cash account. But now we actually have more notes payable. Remember, notes payable is a liability account. So I need some other person, because I want everyone to have a chance at this. I want someone else to go ahead and volunteer for number 2 before I start calling names randomly. Who's willing to step up to the plate?
I'll take a whack at it.
All right. Woo, I love it. Go ahead.
Being that there's more cash in our account, but it is a credit, so I would think that the notes payable is the credit and the cash is our debit.
Excellent. Yes, yes. So we have a debit to cash for $5,000 because we have more cash, right? Every time we have more cash, that goes on the debit side of the account, because cash is an asset. That's how we say we have more. Notes payable is a liability account. So it actually goes on the opposite side. Credit sides increase, liability. So you were absolutely right to say we have a credit to notes payable because we have more liability. We have more notes payable. And that's exactly what I heard as you talk like an accountant. So great, great. You took a good shot at it, and I think you hit a home run. Good. The next one's going to be interesting. Look at the next one. In the third event, remember what happened in the book. We bought equipment for cash. So here we have more equipment, but we have less cash. So Who wants to talk to me like an accountant for that? I need another volunteer. Again, I want to give everybody a chance because this is how we learn. A lot of you are thinking and trying to figure this out, so that's good. So who's next?
Would it be credit cash of 5,000 and debit of equipment of 5,000?
Yeah, that would be right. So more equipment shows up on the debit side of that account, because that's how we say that. And you're right, exactly, Lucas, where we had less cash. So that's the credit side of the account. The other side of the account shows less cash, right? So once you know how an account increases, the other side of the account decreases it, okay? And again, only two things can happen in an account. We either have more of it or we have less of it. That's it. It's the only two things. That's the good news. The interesting news is you got to figure out the sides, and you got to call the sides their proper names, right? That's what we're doing here today. All right, nice job. Look what happened in number 4. Remember when you look back at Sierra Corporation, this client, R. Knox, came in, threw down $1,200 cash and said to you, I'll take these tours later on, right? That was a cash advance. So the customer gave us a cash advance, and now we owe this guy a bunch of tours, right? So when we analyze that in Objective 1, we said, okay, we just got a bunch of cash on the table, so we certainly got more cash, but now we owe this guy a bunch of tours. How do we show we owe a client work? Well, that's the unearned service revenue. So it looks like we have more cash and more unearned service revenue. So I need someone else to come up to the plate and tell me, talk like an accountant. Tell me what happened here from an accounting perspective.
I'll take a shot.
All right, thank you. Come on, Dennis, go ahead.
The cash would be the debit, and then the unearned service revenue would be the debit.
That's the same side.
Oh wait, no, sorry. The unearned service revenue would be the credit. I'm sorry.
My Alexa is just going freaking nuts here. Are you hearing that in the background? Alexa, stop. Good Lord. Dennis, you put my Alexa to work for some reason. I don't know.
I'm sorry.
No problem. I forgive you. All right. Well, you're right on the cash account, right? The cash account, we have more cash. And so we have a debit to cash for $1,200. That's what happened. Because cash is an asset, assets increase on the left side, right? But unearned service revenue is a liability. Liability accounts increase on the credit side. So we would say we have a credit to unearned service revenue for $1,200.
Okay.
And that's exactly, and so that was good. We figured it out. But you're going for every time you say the word debit in account, the other side is going to be a credit. Remember, just like two accounts are affected by every transaction, at least two sides are affected by every transaction. So for every debit, the other account's going to be credited. Okay. So we're always going to have that balance when we do it. And I think that's good to know. All right, let's keep moving on here. Look what happened in example event number 5. They were given $10,000 cash because they gave services. They gave tours to this company called Copa Company. So it looks like they earned some service revenue for cash. So who's next on the list here would like to sit up and take the bull by the horns and give this a shot? Talk to me like an accountant.
I can give it a try.
All right, who's this?
Brandon.
Hey, Brandon, I'm sorry, I can't, I have this small window here. All right, Brandon, talk to me like an accountant.
So I believe that we would debit the $10,000 in cash.
Yes.
And then credit the $10,000 in retained earnings.
It wouldn't be retained earnings. Actually name the account. What happened? They actually earned money by performing services. So what's the name of that account? Service revenue.
I see.
Everyone will see this? All right. So we actually looked to say, okay, we have more cash, but we have more service revenue. So the service revenue account was affected by that transaction. So that's the account we're going to credit. All right. Everyone see the connection there? We're good with that? All right, nice job. Thank you. Excellent. All right, so that's a debit to cash, a credit to service revenue, the actual account. All right, this is interesting because it's the first time we have an expense here. We paid rent. We had a $900 rent expense. Remember, expenses take away from retained earnings, and we paid that in cash, so obviously we have less cash. So this is going to be our first expense. So who wants to step up and try this one? Are you all expensed out? Sorry, bad joke number one. Maybe 2, 3, 4, God knows.
I could take a whack at it.
Okay, take a whack at it. Who's this?
Fran.
Hey, Fran. Oh, yeah, that's right. Here you go. I see you now. Go ahead.
Since we're losing in our account, that would be a debit, but because it is more so in the retained earnings, the balance goes up like a credit. So it's a credit to our account.
All right, well, what account are we talking about first?
Our expenses,
What two accounts are affected by this?
our cash and our expenses.
Which, well, that's too broad. What specific expenses is affected? We just paid rent.
Our stockholders' equity. That's where I'm having trouble. That's the reason why I took a whack at it.
So when you look back, we had basically, we paid cash for rent. So when you pay rent, that's a rent expense. So rent expense is an account, right? You saw that as on your income statement under expenses. You saw a whole list of expenses. One of those expenses is a rent expense. That's a specific account. Okay, so the accounts that are affected are cash and rent expense in this sample. The question is, how would we talk about it in accounting? And it's an open question.
I can try one more time if nobody else wants.
All right, go ahead.
Would you credit the cash and then debit the rent expense?
That's exactly what you would do. That's exactly what. Great job analyzing that. So certainly you know that we have less cash. That's the easiest one to figure out, right? And so you know that less cash goes on the credit side. That's how we say we have less cash. So if you already had your credit taken care of, you need a debit. The debit's going to go to your expenses. All your expenses are going to be debits because all expenses take away from the profit of the company. They take away from retained earnings in essence. And you take away from retained earnings on the debit side. So all your expenses are going to be debits. That you can be guaranteed. Okay. So we're going to debit the rent expense. It's a specific account that we're looking at. Okay. We have to, and that's why I was telling you in the first couple of chapters, get to know those accounts, because all we do in accounting, root word, account, is talk about the accounts. Right. So that was good. Nice try, Fran. Great job, Brandon. Let's go to the next one here. It looks like in the 7th example here, then we bought some insurance. We bought that 1-year insurance policy for $600 and we used up cash for that. So let's see if we can go to a couple of new folks here. I've been happy that everyone's trying. That's the attitude you need to be successful here. But let's go. I mean, what do you think? Aiden or Marcia, what do you think? Anybody want to try?
I'll try it.
Okay, go ahead. Tell me what happened in number 7 here.
Is it a credit decrease to cash and a debit increase to prepaid insurance?
All right. So you're right on everything except using the words increase or decrease. We don't do that in accounting. We know that a debit to prepaid insurance means we have more.
Okay. Oh, all right.
And you'll learn that.
So you don't have to say increase or decrease?
Correct.
Okay, got it.
Of course, that's what you're analyzing up front.
Yeah.
But when you're actually when you're actually going to record it in an account, we either just put it on the debit side or the credit side of an account. So
Okay.
but you're right. We're going to debit prepaid insurance for 600 because we have, as you said, more prepaid insurance. We're going to credit cash because, as you said, we have less cash.
Mm.
Nice job. Let's look at number 8, ocho, one of my favorite words. And here we have an increase in supplies that we bought on account. So it looks like we have some accounts payable going on as well. So we have more accounts payable and more supplies by $2,500. Who wants to take over on that one? I got Delia. Go ahead.
So it is a debit of 2,500 to supplies and then
Yes.
a credit of 2,500 to accounts payable.
Excellent. Yes, yes, yes. So again, once you have, and that's perfect. Once you know what side you're debiting, right? What account you're debiting, the other account is going to be credited because you're always going to have at least one debit and one credit, right? You're always going to have that. So that's always great. And you're right. Supplies goes up on the debit side, and so it's an asset. Assets go up on the left side or the debit side. Accounts payable is a liability. They go up or increase on the credit side. So credits to accounts payable means we have more. Nice job. Next, we paid a dividend, right? Dividends are paid in cash. Look, dividends reduce retained earnings. So just like expenses reduce retained earnings, that's a big hint. So we have paid a $500 dividend and we use some cash for that. So who's going to be brave enough to step up and try this one? Marcia, you've been pretty quiet. Okay. Give it a shot,
So
please.
we have a credit $500 in cash.
Yeah, so
and-
cash, we have less cash. So a credit to cash would show that.
And debit $500 in dividends.
Yeah, the dividends account would have a debit of $500. That's excellent. Nice job. Really, really great. The last one here is salaries and wages. It's salaries and wages is an expense account, right? So it shows that $4,000 more expenses means less retained earnings, less profit. And of course, we pay them in cash, so we have less cash. So let's see. How about, is Elizabeth still there? Are you still there? Are you able to try this
Hi.
one? Why don't you try this one?
So you would credit the cash, and would you credit the expenses?
Well, you already credited one account. So once you have,
So you
again, you're gonna
debit.
for every transaction, you're going to have two accounts affected, but one account's going to be affected on the debit side. The other account's going to be affected on the credit side. So you would never say we have two credits in the same transaction. One has to be debit side, one credit side. So you'll get used to that balance as you practice. So why don't you give it one more try?
So you would credit the cash and debit the expenses.
Specifically, we need to name the account, salaries and wages expense. So, and I think, and that we saw that earlier with another answer where it just expenses is not an account. It's a type of account, right? So we have to make sure that we're naming the expense, like rent expense. That's a specific account that's going to be on the company books. So here the expense is specific, salaries and wages expense. So that's something you all have to watch out for because it's a common mistake or a common thought just to say expense. Yes, it's an expense, but what type, what specific account? Again, we're naming accounts and I think that's critical to keep in mind as we do this. So how did that go? How do you feel about accounts and their debit and credit side at this point? How did that, I'll stop the share here, come back to our main screen. We've lost several people. I guess they couldn't take the credit, but I'm giving you a lot of credit, for hanging in there. Nice job. How do you feel about accounts having two sides, and now you've known the names of those sides? There's a debit side, the credit side, but they act differently, but depending on the type of account it is. Okay, that's going to be one of those things that it's going to take a little bit of time to learn. But I think this exercise helped a lot in having you talk like accountants, because that's exactly how they would talk. Okay. Debit cash for 10,000, credit common stock 10,000. Debit rent expense 900, credit cash 900. That's how they talk. That's how we're going to be talking for the rest of this class and the rest and all of your accounting classes. This is how we talk. This is how we talk. So you will get used to it, but this is just an intro, you know, to this idea of what a debit and a credit side is of an account. And that accounts are different. Different sides do different things to these accounts. Questions at all? We're doing good?
So I guess the only thing that gives me a little bit of hang up is the nature of the increase, in that you can have both it's both acknowledge that the cash is increasing, but in certain circumstances, the liability may be increasing as well, right? In terms of one is a debit and one is a credit. But when it comes to like the income statement, that net is actually going down potentially based on, you know, how high the liability is.
Well, in terms of the income statement, it's going to only revenue and expense accounts are going to be affected. So anytime revenue occurs, that's where the profit is. So that's going to end up on the right side of retained earnings eventually. That net income is going to be part of retained earnings. So revenue is seen as an increase to stockholders' equity, which means it's always going to be on the credit side, because that's how stockholders' equity increases. The opposite is true for expenses and dividends. Those accounts reduce the profit, right? They reduce retained earnings. Expenses reduces revenue right away, right? And dividends reduce those retained earnings. So that's why more expenses are shown on the debit side, because more expenses mean less retained earnings. And that's why dividends are also shown on the debit side, because the more dividends that are paid, the less retained earnings there are. Retained earnings decrease on the debit side. So if dividends and expenses decrease retained earnings, they're going to be on the debit side as well, because it shows that's how they decrease. And again, this is new for a lot of you, and so it's going to take a little bit of practice to kind of get used to this. And you've been sort of distorted by society because of how we use the word debit and credit in society in general. You have to put that out of your head when you're sitting down and doing accounting. Okay, you can't be thinking about what the general knowledge is of it. We're simply specific, focused on accounting here. So debit simply is the left side of an account. Credit is the right side of an account. They don't mean anything else in accounting. Okay. And we never have to use the word increase or decrease or plus or minus or whatever, because in accounting, whenever you debit cash, everyone automatically knows we have more. Whenever you credit cash, everybody automatically knows we have less. So we never have to say the terms in a different, that's the effect. We can say what the effect is, but we never have to use terms other than debit or credit an account. We already know what happened to it just by what side of the account was affected. Okay. Crediting accounts payable, automatically we say, oh, well, we got more bills to pay, more accounts payable. We already know that, just because that's the side of the account that increased. That was credited. Right? So that's how you're going to see some of these things. All right, so now that you've done all this analysis, guess what? And I think you're ready for that big step to actually do accounting. Woo. Y'all like ready to party? Yeah, all right. Break out the spring water. I think it's time to celebrate. Please, I'm looking for some credit on that. Okay. All right, you're all looking at me in that debit look. It's okay. We'll move on. We'll move on. What you're going to learn is accounting starts in something called a journal, an accounting journal. And all it is what you've been doing with me in the last hour. You're going to be, every transaction needs to be journalized. We have to write it in a journal, okay? You imagine accountants, you know, they all have journals, but it's not a Dear Diary type of journal entry, okay? What a journal shows is what account was debited and what account was credited for a transaction. That's it. That's what you're going to be practicing. You already know how to analyze it, so this is just writing it down. It's really not that bad. So let's take a look at journals and how that works. Back to our PowerPoint. All right, so learning objective 3 is basically, now that you know how to analyze all that stuff, it's time to put it down in a journal, okay? An accounting journal is basically where accounting actually happens. All a journal has is the transaction information. Based on this particular transaction, this account was debited and this account was credited. And that's all. That's all it says. Okay. It's the very first place accounting happens in a business, is in an accounting journal. Once you put it in the journal, it starts traveling, but we'll get into that next class. Okay, the numbers do travel. But right now, all we care about is the journal. So again, we've spent the last, the first part of class, really, the last several weeks, understanding the accounts and the statements. Now you learn how to, now that you understand the accounts and you understand those statements, we've learned how to analyze a transaction. Once you analyze a transaction, again, you're going to figure out what accounts were affected and whether we have more or less in each account. Then we have to apply the debit and credit analysis to it. Okay, so if we have more cash, is that on the debit side or the credit side? All right, now that we have more notes payable, is that on the credit side or the debit side? That's all the analysis that has to happen before we actually can put anything down in the journal. So look how much you had to know just to get to this point, right? So we're going to be focusing on the general journal and showing how to do entries. Again, the information does continue to travel, and we'll get to that on the next class. Okay. So the journal is the record of transactions. It's a chronological order. So what you'll see is anything that happened in the journal should have happened in that order through the business day, okay? And it's critical that we analyze and do the journal correctly. Putting numbers and accounts in the journal is what we call journalizing, okay? We're simply entering the data into the accounting journal. So let's go ahead and look at how we journalize. And you already know how to do the analysis. So the journal entry is not going to be that bad, as you'll see. Okay. Everything is really about the analysis. Putting it in a journal is quite easy. Okay. So we're going to take a look at the first 3 events that happened to Sierra Corporation from Objective 1. On October the 1st, the very first thing that happened was they issued common stock in exchange for $10,000 cash, right? So we analyzed it. We said, okay, well, the company now has more cash, but the company also has more common stock, because when they issue common stock, they're selling common stock. So literally, they have more common stock. And they just got $10,000 cash, so that's the value of the common stock that was sold, 10,000. Well, we analyzed it and said, okay, we have more cash and we have more common stock. We had to apply debit and credit analysis. More cash happens on the debit side. More common stock happens on the credit side. and we put it in the journal. So journal is, again, chronological. So the first thing we do is put the date. Now the journal shows the accounts need to be listed. We'll get to this reference next class. It's not really important right now. And notice that there are two columns that the numbers go in. The very, very first column is the debit column. The second column is the credit column. So because the very first column is the debit column, we usually write the debit first. In fact, not usually, we always write the debit first. So the account that gets debited is listed first. The account that gets credited is listed second, and that's because the debit column is listed first in the journal. The credit column is listed second. So cash increased by 10,000. So we show that as a debit to cash for 10,000. This is how it would be written in the journal. Common stock increased by 10,000. So this is how we'd write, right? It's a credit to common stock. Common stock account is the name of the title, and the credit is second. Notice how we simply indent the credit just to show, we usually put the debit account pretty flush against the margin here. But we indent the credit account to show what account was credited and debited, just to show a little bit of a difference. But this is what goes in the journal. You've already done all the hard work. This is relatively easy. That second one, we borrowed $5,000 by signing a note payable. Well, we analyzed it. When you get a loan, you get the cash. The bank, once the bank approves your loan or their lender approves your loan, they give you the cash. So you got more cash. But now you also have a note to pay back. So you have more notes payable. We analyzed this. And now we had to apply our debit and credit analysis. If we have more cash, how do we say more cash? And we say, well, we debit cash. That shows more cash. That's correct. Accounts payable is a liability account. How do we show more notes payable, rather? Well, more is on the right side of the account, which is the credit side. So crediting notes payable is how we would say this. Once you've analyzed it, you're simply writing it down in the journal. Again, I think the journal is relatively easy to do because you've already done all the hard work before you get here. You've already done all the analysis. Now that you know what the analysis is, you're simply writing it down. So here we have a debit to the cash account of $5,000. So cash, again, October the 1st, the cash account gets a $5,000 debit. Notes payable, which is indented, is the credit side account right there. And then they purchased equipment for cash, $5,000. We analyzed it. We said, okay, well, we got more equipment, but we used up that cash, so we have less cash. We had to go ahead and do our debit and credit analysis. Well, what side of the accounts were affected by this? Well, the equipment account was affected on one side. The cash account was affected on the other side. We identified it as a debit to equipment and a credit to cash for the $5,000. So we simply write that in the journal. October 2nd, the equipment account was debited for $5,000 to show we have more equipment. The cash account was credited for $5,000, showing we used up the cash. Okay. This is actually what a general journal, an accounting journal would look like once it's printed out. It'll show basically the transactions in the order that they happened. It's chronological, so it should be in the proper order. And again, the debit column is the first column the numbers go in. So the debit account, whatever account gets debited, is usually listed first. The credit account is second. So the second account listed is for the credit side. You don't have to write out what it was used, what happened, but this is put here to help you understand what happened, so you'd know what that entry looks like. But this is what happens in the journal. All that analysis we went through finally has to get done, and we write it down in the journal. This is where accounting starts. The very, very first place it starts. Okay, for any business. Okay, so let's take a look at this business of Kate Brown called Here It Is. I wasn't so lucky to go to her studio. I must have gone to her competitor. Hair it went, because I'm losing hair as I age. So the very first thing that happened is something you're going to see over and over and over and over again. Issued common stock to shareholders for cash and whatever amount. In this case, is 20 grand. This is something that's going to happen over again because we're looking at, this book takes a corporate view. So all the businesses are corporations, and this is how they start. So it looks like the company has more cash, but they also have more common stock. This is how it would look in the journal. A debit to the cash account. We're assuming that's the debit column here, credit column here. And a credit to common stock. The do it exercise here is done for you. It's in your book on page 108 and 109. The second event that happened is they purchased $4,800 of equipment on account. Remember, I also told you last time you're going to be seeing that little phrase used quite a bit. If you buy something on account, that means they let you take it home and you're going to pay for it later. If you're going to pay for it later, okay, without interest, it's an accounts payable. But it looks like you have more equipment. So you have more equipment, increase of equipment, but you also have more accounts payable, increase in accounts payable. How do we show that? Well, an increase in equipment, as you know, is a debit to the equipment account. Again, you already have your debit taken care of. Your accounts payable is a liability. Liabilities increase on the credit side. So there's your credit. Notice again, you're going to have at least two accounts are affected, and you're going to have one affected on the debit side. The other account's going to be affected on the credit side. Here, the third thing, they interviewed 3 people because they need a hairstylist. Again, nothing happened here. There's no financial transaction, so there's no record. There's no need to record it in the journal. All right, so now we are back to our main screen. How did that go? As you see, the journal is probably the easiest thing you're going to be doing because of all the analysis you had to do to get to this point, right? So it's really in that analysis that is going to help you. That analysis is really the critical thing, which is why I spend a whole day on learning objective 1 doing the analysis, okay? If you get the analysis down, the rest of the stuff is going to fall into place, okay? Any questions on what you just saw? Was it reasonably explained, considering we have some limitations with Zoom? I would do a little bit of a different thing in class, but this is pretty good. You have your work cut out for you over the weekend. You're going to have lots, and this is where I stop in this case. You're going to have lots of work on journaling. So you're still going to be doing all that analysis. You still have to know the account names, all the stuff I mentioned to you earlier, you still need to know. But now you're actually going to be putting it into practice by actually doing bookkeeping, which is the first thing that happens. This is where accounting starts. But it's amazing how much we had to know before we can actually do this, right? It really is. So any last questions or thoughts before we go?